But I would just say gold is more likely to be confiscated than silver. And if you're sitting on gold bars or foreign sovereign coin or generic rounds, and there's a confiscation, you're going to be included. If you own Eagles, you may or may not be included. And if you own pre-1933 gold, the odds are very slim that you would have your coins confiscated because they are considered legally considered collectibles. Capital. The only question is how much capital do you have? Do you have enough capital that you'll be able to live on, pay your property taxes on? I mean, everything's relative as far as size. You know, if you've got just a little bit of gold and silver, yeah, it'll help you eat, but it's not going to help you pay taxes.
The U.S. Mint has already told us they're out of 10th-ounce Eagles. My guess is we won't see any new ones until 2025. We've been doing some really big orders lately. Seriously, some very big orders, and people have an affinity for silver Eagles. We're already buying, allocations into October. At what point does the U.S. Mint say we're out of silver Eagles until the end of the year? It's coming. It's going to be very close. And if I had to guess, and we're beginning to see that already, junk silver is becoming hard to get again. Silver Eagles are becoming hard to get again. And so the 10th-ounce Eagles are gone. And at what point does it become a realization to the masses that they need gold and silver? By then, my guess, you will see product be very difficult to get. Premiums will pop up in a very material way.
Price level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to $850. Okay. Or from 2000 lows of about $265 gold, and you went to 1920 by 2011 over the next 10 years or so. Okay. That's an 8-fold move. Well, we started from a bare low at 1,050. You do the math.
In today's mega recap, we bring you the best clips of the most sought-after commodities experts like Andy Schectman, Michael Oliver, Bill Holter, Craig Hemke, and Gerald Celente. They share their insights as gold price is making all-time highs day after day, and silver price soars above $31 after Fed's bumper rate cut decision. We watched hours of footage, so you don't have to. So make sure you smash the subscribe button, hit the like button, and turn on notifications. Check our description for full vid credits. Enjoy the episode.
Yeah, you can't do a rule of thumb because you don't know what the future purchasing power is going to be. It will increase from where it is now. How much, you have no idea. It may be that if you've got 200 or 300 ounces of silver, that might be enough, depending upon what the revaluation, what the reset is. All I can tell you is historically, if you had 1,000 ounces of gold or 10,000 ounces of silver, you were a wealthy person for hundreds and hundreds of years. Do those numbers, will they still work? Yeah, I think they probably will, but there's no way to know exactly what the purchasing power is going to be. And I would say you can only do the best that you can do with what you have. I mean, one person may have saved a grand total of $50,000. Somebody else may have saved $5 million. It means the same to each person because that's their nest egg. And the one that's at 50,000, can't do anything to get the 5 million. So do the best you can. And I would just say the rule of thumb is you only leave in the system what you need for current bills, and you take everything out of the system that you don't want to lose, because in the system, you're going to lose it. Do the best you can. There is no way. I guess there is a way. If you could do the math based on today's pricing and today's purchasing power, if you're comfortable now, you should certainly be comfortable later because the purchasing power is going to pick up. I don't know. Is it going to double, triple, quadruple? Who knows? There's no way to forecast that. But understand that the purchasing power will pick up. So, if you've not been able to accumulate thousands of ounces of silver or hundreds or thousands of ounces of gold, don't fret, just do the best you can. And it may work out that what you're thinking is not enough today may end up being enough to get you from here to the next system with wealth intact.
How would we ever continue to get this information? And thank God we got as much as we did. And he's the one who alerted us originally, and Big Swear also, to the fact that Bank of America had a 1 billion ounce silver shortfall, naked short position. And the same thing is true about their gold, 35 million ounces, 40 million ounces short, all of it on the OTC market. Maybe that's why he's pulling ranks. Are they going to sacrifice a bank like Bank of America? Certainly think it's possible. It would be very easy for them to do that. And much to the motto these days, find a scapegoat. It wouldn't surprise me one bit at all. And, I don't know what the trigger point will be for every man for himself. But if I had to guess, that's where it is. They will blame a bank like Bank of America, who is so egregiously short, and they'll let them take the fall. To me, it seems relatively logical if you look at the way that these actors are doing things. But yeah, like I said, it's easy to manipulate a market when everyone is pushing in that direction. It's another thing when you have countries that are going out of their way to accumulate gold and silver, and even using clandestine approaches where they're trying to hide it. But ultimately, the market wins, and the market is bigger than all the manipulations, and all manipulations end badly. So yes, one way or the other, it gets to that point where they all start, swimming for themselves. But if I had to guess, someone's going to pull Bank of America down underneath with them. That would be my guess if I were going to make one guess into the coming months. Here, there's no way it could. And what Jim Rawls says is very true. This is the era of betrayal and deception. And if you don't see that by now, then you're gaslit, and you probably won't. I don't know how people don't see it by now, but look. I've played golf at that course where Trump was shot at again, or attempted to be shot at, several times. Every time I've been there, I've seen him, and he's always come up and said hello to us, as a side note. But, it's just very surreal to me that we've had two attempts on a former president's life, and it probably won't be the last. You can tell that things are starting to get intense. I don't know, Dunnigan. I think it's one of these deals where, people need to wake up very quickly. And I know we're doing our best to help people do that.
One more aspect of that I wanted to jump in on was something you've talked about.
The typical groups, the typical funds, the home office accounts and stuff like that trade gold futures, they're already long. And the short side has been reduced heavily. And so there's just not a lot of buying pressure, new buyers and stuff to follow through and keep chasing price higher. And so that's kind of why I guess to me, that's a real world application of that COT report, which you can't really use to trade, but you can use if you understand where price was and can correlate that with COT positioning. And then you can kind of begin to anticipate what might happen next. And so that's kind of why gold is kind of stuck where it is, even though it is $2,550. And that is how it works. I get people on X come at me and say, well, if gold's manipulated by the banks, how come it's gone from 400 to 2,400? I'm like, you're not looking at it like a friggin' banker, right? Bankers just want to they want to capture the spread. They want to incrementally make money every quarter, right? That's how they roll. That's why the old notion, rest his soul, but the notion from Ted Butler that one of these times JP Morgan was going to stand down and make all this money. They haven't accumulated 160 million ounces in their vault because they want to make one huge hit. That's not how bankers, if you've ever met bankers, man, that's not how they do business. They want to make money month after month, quarter after quarter, consistently grow it. So gold goes up, and that's fine with the bankers. 10% a year is what gold's done since the year 2000 on average. Okay. They can work with that. What they can handle is 50% in a year. I mean, we're pushing the extremes here right now at 25. Okay. That's They're getting underwater in some positions, getting wrong-footed here and there. But when it just incrementally go, or think of them as a retreating army, right? We have this land, and now so we fall back, we build new barricades here, then we fall back and do it again. That's the way to think of the price management, that it moves up in stages. And again, we blew out in March into April. In a sense, it kind of got overrun a little bit with hedge funds that were short, that were covering, got buy stops as price moved up, and they got a whole bunch of momentum of people coming in. But then it's not surprising that then, we run into this new range where every time it goes to 2,500, straight back down, it goes up, then big red candles again, up, big red candles again. So we're in, as long as the COMEX remains the primary pricing scheme for the precious metals, then all bull markets are going to kind of reveal themselves in this same process of kind of 2 steps forward, 1 step back, where the speculative money comes in, the banks take the short side, you run out of momentum, price begins to tip over, technical indicators start to tip over, the speculative money rushes back out, the banks cover up half of those shorts that they put on. Hopefully you just put in a new higher low, the uptrend continues, something else happens, here comes their name, same rush of money again, open interest expands, the funds get long and the banks get short, and then they run out of momentum again, and you just get this higher highs and higher lows. That's how it works in gold and silver, and that's kind of how we're trading this year too.
In today's news recap, Bank of America expects declining silver inventories to make the deficits count. The Silver Institute shows that the silver market has been in a deficit for the last 5 years. And during that time, we've seen substantial decreases in global inventories, which makes sense, as the metal has to come from somewhere to meet the shortfall. Yet, with no resolution to the gap in sight, as the deficits are widely expected to continue years into the future, a recent Bank of America report suggests that the declining inventories are starting to make the deficits count. Their report also commented on China's surging silver consumption, which has continued to grow in 2024 as their solar production has, again, exceeded expectations. And with governments calling for a tripling of green energy by 2030, the demand for silver is going to have to increase if the governments are going to get anywhere even close to meeting their targets. China has already shifted to being a net importer of silver. And we've personally talked with one of the larger silver producers who told us about how Chinese smelters have been going directly to Latin American silver producers and offering substantially reduced treatment charges because they're able to take advantage of the increased premiums in China. Now, we'll show you more clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps.
Going on to the markets, the Dow is up because the inflation numbers that came in today. And let's see, the producer price index reflected a 0.2% rise in wholesale prices. So that means the Fed's going to lower interest rates. The bet is how much they're going to lower them. The street's saying 25 basis points. Others are saying 50 basis points. Again, this isn't rocket science. The lower interest rates go, the deeper the dollar falls. The deeper the dollar falls, the higher gold prices go. And the dollar's in for a deep fall this fall. You ready? Interest payments on the national debt top $1 trillion as deficit swells. Isn't that a nice prostitute headline from CNBC? Payments on national debt. How about disaster? Who could pull off this shit and get away with it? Scumbag politicians, that's who. You go deep in debt. You let your deficit swell. You're gone, man and women. You're screwed and not the way I like to be. Yeah. But the government, they could pull all the fucking shit they want. Okay. The government has laid out $1.049 trillion in debt, up 30% from the same period a year ago. The jump in debt service cost the U.S. budget deficit surged in August, edging closer to $2 trillion for the full year. No, the dollar's not going to die. It's going to stay great. Again, this is the beginning of the death of the dollar. And again, who could get away with this bullshit? Oh, the markets went up. China's rapid slowdown drives world oil demand growth downturn. According to the IEA, it's from the Wall Street Journal. Yep. Oil prices went up today, $2 a barrel about. Because there's a storm down in the Gulf of Mexico. Total.
Oh, come on now. That ain't even bullshit. That's horseshit.
In the first half of this year, global demand growth continued to decelerate with gains of 800,000 barrels a day, the lowest since 2020, according to the IEA. 2020, the height of the COVID war. That's where oil is. That's how slow it is. Again, the numbers are all there. And this is, by the way, old news. It's in your Trends Journal this week. Last week, the week before, and the month before, and the month before. The only thing that's going to bring oil prices up is Israel's ramping up the Middle East war and the United States. And
Nothing but a head fake. It's the little boy who cries wolf. And one of these days, the wolf cometh. And that's the point. And it just appears as though, in many respects, the wolf is already here. Now, is this the one where it just keeps on running? Is it possible that we see 2,600, 2,700, 2,800? How about 3,000? You take the commercial bank suppression out of the markets, and the price of gold and silver will be massively higher. And the worst part about a long-term macro cycle, which we have been in, is that most people aren't capable of processing the fact that this could actually happen here. That recency bias, that normalcy bias will be the worst thing for people to hang on to. And you have to take a step back and look at what the most well-informed traders in the world are doing. And that is the fact that they are selling treasuries, pushing up the yield on the back end of the curve. They are accumulating commodities. They are distancing themselves from the West. They are formulating alliances and bonds, and either you believe it for what it is or you don't. And you talk about the BRICS. Yes, it's a slow-moving process. But I've read just recently that now they're talking about bringing in all of these other groups from Asia, bringing in the Eurasian Economic Union, bringing in the Shanghai Cooperation Organization, bringing all these groups into the fold slowly and methodically. But you're beginning to hear more and more and more about bringing all these countries into the fold, which are representing the majority of human population. And this is something that isn't going away. Yet you don't hear word one about it in here in the West. And so all of these things that you're saying make so much sense to me. Everything that you've just said makes so much sense to me and to the people listening. And it makes it that much harder for us to want to help our families and to see their reaction. We've got to the point now where I think it's you can only save the world. Starting with one person, starting at a time, with yourself, your immediate family. The noble endeavor of trying to help everyone. I think at this point, if you don't see it, you probably won't until it's already here upon you. But yeah, I think this is right now, right here where we are, almost to the month of October. Look, in the month of October, you have this massive meeting with the BRICS, only then followed by the election. And things are going to start to get very interesting and be very difficult for people to ignore. And I guess people are they don't believe that gold and silver can continue to go higher. My belief is that gold and silver should be massively higher already, but for the actions of the 6, 7, 8 commercial banks that have done their best to maintain a Western illusion that is breaking. And it's breaking because our allies that have helped us support that illusion are breaking ranks and moving in a different direction. And India is a prime example, as is Saudi Arabia. And they're so concerned about the way that we look at this, or the way that the West looks at it, that they're trying to do it in a private manner. The same thing is true about China when they told us that they weren't buying any more gold. Baloney, the import-export numbers show that they've been buying gold. And as we talked about, through their proxy banks, through the commercial banks that are able to buy from the refineries in South Africa and in Switzerland that aren't reporting it to the IMF because it's not coming from the central bank, and all sorts of other avenues on top of being the largest producer of gold in the world and the second largest producer of silver, and then flying all around the world buying up doré bar and concentrate so that it doesn't come off of an exchange. All of these things put together shows you the tremendous effort that these countries are putting into de-dollarizing without stepping on the foot of the king, until they have enough of a mass behind them where the king isn't as relevant as he once was. So yeah, I think we're getting there. And I keep saying this, that it's going to be crazy the few weeks leading up to the election. It just seems that we're already there. And I guess we'll be able to watch it shotgun here real time over the next 8 weeks to see how it unfolds. But I think 26.
In today's news recap, silver price soars above $31 after Fed's bumper rate cut decision. Silver delivers a sharp rally above the crucial resistance of $31. The white metal strengthens as the U.S. dollar surrenders its early gains and declines. The U.S. dollar weakens as the dust settles after the Federal Reserve's monetary policy decision, in which the central bank announced its first ever interest rate cut in more than 4 years. Historically, lower interest rates by the Fed bode well for non-yielding assets, such as silver, as they reduce the opportunity cost of holding an investment in them. The U.S. dollar index, which tracks the greenback's value against 6 major currencies, falls following the Fed 50 basis points interest rate cut. The Fed was widely anticipated to cut interest rates, but traders were divided over potential rate cut size. A bumper interest rate cut by the Fed gives a clear indication that price pressures are on track to return to the bank's target of 2%. For the interest rate guidance, policymakers see the federal fund rate heading to 4.4% by year end, which suggests that there will be at least more decline in interest rates. On the contrary, the CME FedWatch tool shows that the central bank will cut 75 basis points in the remaining monetary policies this year. Silver price strengthens as it has delivered a breakout of the downward sloping trend line plotted from May 20th high of $32.50. The asset is expected to extend its upside towards the previous high. Upward sloping 20-day exponential moving average also suggests that the near-term outlook is upbeat. Now we'll show you the best clips of the latest interview, but first smash the subscribe button, turn on notifications, and check our description for full vid credits. Enjoy the episode.
2008. And was somewhat overbought then. And so when the stock market finally did have a crash event in a year off of its high in that 2008-9 bear, gold joined in. It joined in for all of about 4 to 6 weeks, where they were, they're going the same way. They weren't going the same way before. And then shortly after that event, stock market continued on down through the first quarter of 2009. Gold was back at its highs by early 2009. So they diverged. But there was that brief instance, and everybody remembers that, at least if you're around then. But if you go back through history and look at even crash events, like I happened to catch the crash in 87 before I set up MSA. I didn't catch it a big way, but I caught it to where it smacked me in the face with realization that, hey, we can measure some of these things, okay? At that point in time, gold went up 9% that was a week or two of that crash. Why? I guess nobody told gold was supposed to go down, when the S&P crashed. But no, it went up anyway. And during the 29 to 32 great bear market, there was no gold futures or freely traded gold then, but Homestake Mining, the biggest gold miner in the world then, had a massive bull market during that huge bear market. Okay, so opposite the stock market. So the attempt to link gold to stocks as a fear element. Yeah, pay attention to it. Yes, if gold were excessively overbought at that point in time, when the stock market decides to really have a puke, then maybe gold will participate to some extent to clean itself up some, or not. So don't think it is a rule carved in gold stone that it must follow the stock market. It certainly doesn't. Okay. Anyway, in the 2007 to 2009 bear trend, the stock market down the whole year and a half period, T-bonds and gold went up. From 2000 to 2002 bear market, gold went up, T-bonds went up. Okay. So here we are. I think we're topping out the stock market. Yes, we've taken out the 2022 price highs by about 10% or so in some indices. Some haven't even reached it. And if we roll over here, we think there's triggering factors in the S&P 500 and the NASDAQ 100 that will be engaged in the next quarter. If you merely ooze back down about 5% below where you're trading right now, those indices can't sneeze between now. So if September, for example, unfolds as a wobbly month, and we ooze back down several percent, you'll be in a position via our momentum metrics to trigger a structure, break a structure of support level that suggests you could open the Bombay door. Now, it doesn't have to be a crash, but it's likely to be a very sharp onset of major decline. And I think that the Federal Reserve and the monetary factors around the world will increase dramatically liquidity, artificially low rates. It's all the things they do, and that will benefit gold. So anyway, but we do see the stock market being in a very vulnerable position to where September better not be a wobbly, non-headline, but just wobbly a bit, pull back 3, 4, 5%, because you'll be in a position then to trigger certain momentum factors that say, gone. You'll go down. Anyway, so that's what we see in the stock market. And a nice level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to $850, okay? Or from 2000 lows of about $265 gold, and you went to 1920 by 2011 over the next 10 years or so, okay? That's an 8-fold move. Well, we started from a bear low at 1,050. You do the math. Yeah, we're double and a half. Okay, so no comparison in terms of how much multiple gain has gold had so far in this, 9-year-old bull market. So if you use those old metrics and say, well, we can do what we did then, sure you can. The fundamentals are even more dramatic now. Gosh, you can have $8,000 gold. Now, that's not a target. It's just noting past history. And we also note that back in those periods when you in those bull surges, and by the way, I'd comment on that, maybe have an after comment on this. When you ended those bull surges, that last several quarters of the bull market, you went parabolic. Gold went up hundreds of dollars. Silver went from, like you said, 20 to 50 in a matter of, several months. The same was true in 79 to 80. It's also true in mid-2010 through April 2011 for silver. You went absolutely off the page. Right now, silver's, well below those price highs, $50. Why is silver? Gold's above those comparable highs. Even copper recently traded over $5, taking out its 2011 high and its 2020 high. And yet silver's still, $30, let's say, it's $20 short of its peaks. Do you think he can't get there and maybe go past it? Well, be reasonable. Maybe silver's just lagged for certain reasons. And once markets like that get shocked into a new reality, they tend to go berserk. And I think that's probably what's going to happen, is that silver's going to vastly outperform gold in the coming months.
What do you think of Hemke's take? Do you believe gold has hit its yearly high as the so-called banksters continue to push prices down, or do you think he's off the mark? Drop your thoughts in the comments and let me know your price predictions for both gold and silver by the end of the year. Now make sure to check out this next video. It's a perfect fit for you. I'll see you on the other side.